Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and in this video we're going to be talking about an important topic called inflation. So in the year 2017 that we're currently in, inflation is 2.34, and in 2016 it was 1.26, and in 2015 it was 0.12. So prior to that, in the crash of 2008, the inflation rate was 3.85. So that's something to kind of take a look at compared to these, this year. What's next year's inflation going to be? We'll have to take a look at that here in a year or so, just to kind of look at it. But anyways, back to the video. Why is inflation important? So our inflation today in the United States is 2.34. What is inflation? Inflation is the increase in prices and the fall of purchasing value of money. As an example, items throughout the year due to inflation will increase, making your money value decrease. So your money value doesn't decrease just because the value of the money decreases. It increases because the items that you're purchasing have actually increased with the inflation of the United States. So if you have a $10 pair of headphones that you bought in 2016 and they broke and you go back to the store in 2017, the item has probably increased by 23 cents. We're not including the 4 because it's going to be rounded down. So that pair of headphones that you just bought is now $10.23. So why is it important to check for inflation every year? You want to know what you want to beat for the year. 2.34%, if you're smart about it, isn't too difficult to beat, but a lot of people don't know how to beat it. They leave their money in a savings account, or they leave it in a 401k. 401k probably beats 2.34%. So we'll just take a look at savings accounts. So as an example, we'll say Chase. Chase is a pretty well-known bank that lots of people invest in. They invest because they put money into a savings account and it earns them an interest rate. Chase's current interest rate for a savings account, I think of $1 million or less, it's like $999,000, is 0.01%. So if you left your $10,000 in a savings account at Chase, you would have been paid $10 for the whole year. That's 0.83 cents a month. Can you see that 0.01 and getting paid 83 cents a month is not going to beat the inflation? So 0.01 is 2.33% below the inflation rate. Your money's sitting there not earning you anything. So what are some ways we could have beat the inflation? Say we have $10,000, and we'll just kind of bust out our calculator here, and we're going to bust out our notepad. And we have $10,000, but we don't want to spend our full $10,000. We want to just spend $5,000. So we'll take a look at just Chase as an example. We'll take a look at Chase stock. So Chase stock is currently $86.18. But a year ago, if we took that $5,000 and purchased their stock at $62.37, so $62.37, let's see, 5,000 divided by 62.37, because we don't want to put the full 10,000. What if something goes crazy and we need this $5,000 to either pay off our mortgage, pay for your rent, pay for your mortgage, you have medical bills. You never want to put more than, I don't like putting more than at least half of what I have saved. It's not really good to have it in a savings account, but you need it when you need it, and you don't want to lose its value. You want to be able to leave your investments in the investments. That's what they're there for. So $5,000 is what we're going to use. We purchased some shares of Chase, and that gives us 80 shares of Chase shares. Chase shares. Now, and if we took that and we waited the whole year, they've increased by 38%. Their stock increased by 38%. So does that beat inflation, that 38%? Yes. That inflation was only $234. So $10,000 to beat the inflation, we would have had to make $234 to beat inflation. 2.34 times 10,000 is 234. So let's go back to our calculator and let's go back to our Chase stock. And right now, if we looked at our paper here, and right now the current value of Chase is 86.18. Say we're done, we don't want to invest this year, let's take out our shares, so we're going to cash them out. And we have our 80 stocks and we have our current price. So we're going to go 80 times 86.18, and that's going to get us $6,894. So $6,894.40. So our initial investment was $5,000, and we made minus $5,000. We made $1,894.40 minus 15%. Say, whoops, taxes. There's taxes on. Whoops, that's not right. 194.40. You get tax on your money that you made, so that's minus $284. We'll say minus 284.16, and we came out with 106. Blah blah blah. There we go. $1,610 for that year for just leaving your money in there. But we also had dividends. Chase pays a 2.32% dividends. So for that, for those 80 shares, we'll just use the initial. We'll just take the 62.37. So 62.37, and they pay 2.32%. I'm sure it was a lot higher. We'll just take the current. So 86.18 divided, alright. Where's my calculator? 86.18 plus 2.32% is $1.99. So their dividend, they pay $1.99 for every stock that you own. So we own 80 stocks times $1.99, or $2 rounded up. That would put us at $160. So times 2, 180. Whoops, $180. So $180. That's why I use my notepad and my calculator. So total, and then dividends also gets taxed. So yeah. So $180. We'll just say minus 15%. It would have been $26. 26 minus $26, and you're left with $149.90. So total for the year that you left your money invested in Chase is $1,760.14. And to beat the inflation rate for $10,000 in your bank account, you would have just had to make $234. So in a year, we beat inflation really easy. Now, why did I use Chase? Chase is a bank, and it's not going anywhere even during crashes. If you take a look at they've been around since 1980s, and even during the crashes in the 1900s, they've recovered. In the 1998 crash, they recovered. In the 2000 crash, they recovered. It took them a little bit longer to recover here. They didn't actually start making a recovery up until for about 15 years, but they would have paid you dividends. So even if you had your money in there long term, which a lot of people are doing, you want money long term. Your money is not actually losing value up until you sell it. So if you had $10,000 here, they would be paying you the entire time that you own their stock. Plus, if you put more money in, your yield would have increased and they would have paid you more. And you could have cashed out at 34% increased. And yeah, that's just one way looking at it. So that is how to beat inflation as an example. And some people that work $15 jobs and they get an increase of 2%, that's 30 cents. So if they got, say, a quarter increase in a year, if they were getting $15 and their boss gave them a quarter raise, they fell behind in inflation this year because the inflation rate is 35 cents. It's not 30 cents, it's 35 cents because that 2% is 30 cents, and that 0.34 is 5 cents. So to beat inflation, they would have had to go 0.35 just to match the inflation. To actually beat it, they would have had to get at least a 36 cents raise. That would have been fine in 2015, 2014, but in 2017, when the inflation is growing high, you need that higher increase in when you're getting paid. I don't know what it's called. When you get your yearly review, you need to beat that inflation. So inflation is an important thing. Hopefully, if you found this video interesting, hit that thumbs up button below. Thanks for tuning into this channel. We will be focused on setting ourselves up financially for the future and ways to beat the inflation and become ways to become a financial investor. If you enjoyed the video, please remember to like, comment, and subscribe for future financial videos. Thanks for tuning in, and I will see you next time. Bye.